Welcome to GexPro Daily Market View. What matters right now is volatility hiding under the surface. The main risk is crowded positioning meeting tightening liquidity at the worst possible time of year. The main opportunity is patience, letting stretched trades unwind and stepping in where structure actually holds. This is a market that looks calm on the index, but it's anything but underneath. We're sitting in an environment where liquidity is thinner than people want to admit. The central bank stays restrictive in tone, even if the market keeps hoping for relief. Cash levels across institutions are low, leverage stays high, and that combination matters now because January doesn't forgive sloppy positioning. When liquidity comes back after the holidays, price starts telling the truth. That's usually where weak hands get exposed. You see it clearly in metals first. Physical silver trades at a massive premium to paper, and that disconnect is not normal market behavior. That's stress. Margin requirements rise. Paper traders are forced to sell, and physical holders don't flinch. That's not a clean bullish signal, but it is a warning. When paper and physical stop agreeing, volatility follows. Silver becomes a trader's market, not a chase. Most of the easy upside is already gone, and this is where people usually get trapped. Zooming out, this isn't just about one metal. It's about confidence in paper claims versus real assets. Precious metals move because currencies feel less stable, not because of a single demand story. Supply responds slowly. Production lags. And while prices can overshoot, the bigger picture is an unwind that has been building for years. Timing is everything here, and right now timing is messy. Equities look strong on the surface, but breadth tells a different story. A lot of stocks quietly roll over while the index holds up. That's rotation, not collapse yet. Institutions rotate, retail chases headlines. Big money sells strength, not weakness. You see it in dark pool activity, especially in equal-weighted indices. That's distribution behavior, not bearish by itself. But it does change how you trade. Tech still leads, but leadership narrows. Earnings growth carries the index, while multiples stop expanding. That tells you expectations are capped. Financials benefit from debt and data center spending until yields rise too far. And long-duration bonds are flashing that warning. Long-end yields push higher, even as the market talks about cuts. That divergence matters. Credit always speaks before equities listen. Defensive sectors quietly build bases. Healthcare creeping back toward prior highs isn't exciting, but it's informative. Late cycle behavior doesn't ring a bell. It whispers. Energy, on the other hand, refuses to confirm inflation fears. Oil stays range-bound. No breakout. No panic. That weakens the stagflation narrative for now. Options positioning tells you where the landmines sit. Puts stack up underneath the market, creating short-term support until they don't. As long as those levels hold, dips get bought. Lose them, and you don't get a gentle pullback. You get air pockets. This is why patience matters more than prediction here. Crypto confirms the indecision. Bitcoin compresses between clearly defined liquidity zones. No trend. No follow-through. That's balance, not strength. When crypto stops moving, it's waiting on macro, not leading it. The dollar trends lower. Yields trend higher. Metals stay volatile, and equities grind sideways. That mix screams transition. Not a crash. Not a melt-up. A market resetting expectations. This is where experienced traders slow down. You don't chase extended moves. You don't short strength blindly. You wait for price to come to levels that actually matter, and then you act. 3 things to watch. Silver holding its key support zone. If it fails, volatility accelerates. Long end yields pushing higher. That's pressure equity markets can't ignore forever. Index support levels tied to heavy put positioning. Hold them, and we grind. Lose them, and things get fast.